When a spouse dies, taxes often go up, even though income goes down. Most people have no idea this is coming. The IRS doesn't give grieving families a break. It quietly shifts them into a filing status that costs thousands more every single year. This is called the widow's penalty. It's legal, it's automatic, and it blindsides even people who thought they had retirement completely figured out. Here's what actually happens, why it hits so hard, and yet most importantly, what couples can do right now to soften the blow before it arrives. Stay until the end because the final strategy is the one most financial planners forget to mention, and it could save a surviving spouse tens of thousands of dollars. To understand the widow's penalty, start with how married couples file taxes. Two spouses file jointly, married filing jointly, or MFJ. That joint status comes with a generous standard deduction. In 2025, it's $30,000, a big chunk of income that never gets taxed. The year a spouse dies, the survivor can still file jointly. That's one last year of the better rules. But the very next year, unless there's a dependent child at home, the survivor must file as single. That's when the penalty hits. The single standard deduction in 2025 is only $15,000. Overnight, the survivor loses $15,000 of protection. Just gone. That missing $15,000 doesn't vanish. It becomes taxable income at IRMAA. The IRS now taxes money it wasn't touching before. But the deduction cut is only half the problem. The tax brackets themselves get squeezed hard. Here's what most people don't know. Single tax brackets are roughly half as wide as joint brackets. The exact same income hits higher rates much faster. Take the 22% bracket in 2025. For a married couple, it runs all the way up to $206,700. For a single filer, that same 22% bracket stops at $103,350, almost exactly half. The 24, 32, and 35% cutoffs follow the same pattern, all about half as wide for single filers. So the survivor lands in a higher bracket at a lower income level, paying a bigger percentage on a smaller paycheck. That's the core of the widow's penalty. Now add the income drop. When one spouse dies, Social Security doesn't keep paying both checks. The survivor keeps only the larger benefit and loses the smaller one. That loss is real. Household Social Security income typically drops by roughly 1/3 to 1/2 when one spouse passes away, so the survivor is working with less money and getting taxed at a higher rate on that lesser amount. Less in, more out. A true double squeeze, and the retirement accounts don't pause to let the survivor adjust. Required minimum distributions, RMDs, keep coming every year, no matter what. RMDs are the IRS forcing retirees to pull taxable money out of IRAs and 401k accounts each year. That income is fully taxable. For a couple, those RMDs landed on a joint return with wide brackets. For the survivor, those exact same RMDs now land on a cramped single return, taxed harder. This is the moment most people don't know is coming. Same IRA money, same account, same distribution, but a bigger tax bill because of the filing status switch. Let's make this real with an example. Take a retired couple bringing in about $120,000 a year. 2 Social Security checks, some RMDs, a pension, they're comfortable. Their joint filing status, wide brackets, and $30,000 deduction keep their effective tax rate manageable. Then one spouse dies. The smaller Social Security check disappears. The survivor's income drops to roughly $85,000, but now the survivor files single. The deduction is half. The brackets are half. And that $85,000 gets taxed at a higher effective rate than $120,000 ever was. Less income, bigger tax bill. That's not a mistake. That's exactly how the current tax code works. This hits millions of surviving spouses every single year. And there's still one more hidden cost most people overlook entirely: Medicare, specifically a surcharge called IRMAA. IRMAA stands for Income-Related Monthly Adjustment Amount. It's the IRS and Medicare working together to charge higher income retirees more for their coverage. Here's the real reason this stings. The income thresholds that trigger IRMAA surcharges for single filers are roughly half of what they are for joint filers. A survivor with the exact same income or even lower income can suddenly cross an IRMAA cliff and owe $800 to over $5,000 more per year just for Medicare. So the penalty isn't just federal income tax, it's the deduction cut, the bracket squeeze, the lost Social Security check, the RMDs still coming in, and now higher Medicare bills on top of it all. Every one of those costs hits the same person in the same year at the worst possible time. That's the full picture of the widow's penalty. Now, here's the question that matters. How much do you think a surviving spouse should set aside to cover the tax jump? Tell me your number in the comments, because the real reason couples get blindsided is that they plan for retirement as a team. 2 incomes, 2 Social Security checks, joint filing, and never model what happens if one of them goes first. Most people don't know there are specific moves, legal, effective ones, that can dramatically shrink the widow's penalty before it ever arrives. Here's how. The single most powerful tool is the Roth conversion. Here's what it means. Taking money out of a traditional pre-tax IRA and moving it into a Roth IRA, paying tax now, not later. The key is doing it while both spouses are alive and filing jointly. Those wide joint brackets mean converting at lower rates today, which lowers the RMDs the survivor faces tomorrow. Every dollar moved into a Roth while both spouses are alive is a dollar that never becomes an RMD. Roth IRAs have no required distributions. The money grows tax-free. That matters enormously for a surviving spouse. Fewer forced distributions mean less taxable income, which means staying in lower brackets and avoiding IRMAA cliffs. The window to do this is the joint filing years, ideally before either spouse reaches the age when RMDs kick in and the income gets harder to manage. The second strategy, draw down pre-tax accounts strategically while both spouses are alive. Pull money out of IRAs and 401k accounts during the joint years in the lower brackets. Realizing gains while filing jointly, selling appreciated investments, and harvesting the gains also locks in lower rates before the bracket squeeze arrives. The third tool is managing income around IRMAA thresholds. A good planner maps out exactly where those single filer cliffs are and designs withdrawals to stay just under them. This isn't about avoiding taxes illegally, it's about timing and order of withdrawals. Which account gets tapped first by how much in which year? Every detail counts. The fourth strategy addresses the lost Social Security income directly. Life insurance, specifically a policy on the higher earning spouse, can replace that missing monthly check. When the higher earner dies, that larger Social Security benefit goes away. The survivor keeps only their own smaller check. A death benefit can fill that gap for years. None of these strategies are complicated in concept. What makes them hard is that most couples never think about the single filer scenario at all until it's too late to act. The time to plan for the survivor's tax situation is while both spouses are alive, healthy, and still in those generous joint brackets. That window doesn't stay open forever. Here's the move that most financial planners forget to mention, and it ties everything together. Run the survivor's plan now. As a standalone projection, take the couple's current income sources, Social Security, pensions, RMDs, and model what happens to each one if the higher earner dies first. Then model if the lower earner dies first. Apply single filer brackets and the $15,000 deduction to each scenario. Find out where the IRMAA cliffs land. Calculate the actual tax hit. That number shows the gap between what taxes look like as a couple versus what they'd look like for the survivor alone. That's the widow's penalty in real dollars, specific to that family. Once that number is on paper, the right mix of Roth conversions, strategic withdrawals, IRMAA management, and life insurance becomes obvious. The plan writes itself. Tens of thousands of dollars over a survivor's lifetime can hinge on decisions made years before the first spouse dies. That's the scale of what's at stake here. So back to the biggest question, why would taxes go UP when income goes down after a spouse dies? Because the switch from joint to single filing cuts the standard deduction in half, from $30,000 to $15,000, instantly, and it compresses the brackets. The 22% ceiling alone drops from $206,700 down to $103,350, and it can push a survivor above the IRMAA line, adding hundreds or thousands per year in Medicare surcharges, on top of everything else. The income drop doesn't cancel any of that out. It only makes the squeeze worse, less money coming in, more of it going to taxes. That's the widow's penalty, start to finish. The couples who escape it aren't lucky. Ross, they planned. They ran the survivors' numbers early, converted pre-tax money to Roth while the joint brackets were wide open, and managed every cliff along the way. The widow's penalty is built into the tax code. It can't be repealed in anyone's living room, but it absolutely can be shrunk, sometimes dramatically, with the right moves made at the right time. If a spouse has money sitting in a pre-tax IRA right now and both partners are alive, the clock is already running. Every year without a plan is a year of Roth conversion opportunity gone. Run the survivors' numbers, model both scenarios, find the gap, then fill it before the tax code does it for you.